Good evening and welcome to Boston University's Real Estate Club Guest Speaker Series, for conversations about real estate, leadership management, and people who have achieved something in our society. Greg Friedman is certainly that. He's the co-founder and CEO of Peachtree Hotel Group, which is a private equity group that has completed hundreds of real estate transactions valued at more than $5 billion in market capitalization since its inception in just 2008. Very impressive to say the least, Greg. So thanks for coming tonight.
Yeah, thank you for having me.
So, Greg, one thing that we'd all love to know, especially myself, I'm really curious. How does a young man originally from Fayette, Alabama, with an eye on a medical career and having received a degree in biology from the University of Texas, end up running a multi-billion-dollar private equity real estate investment platform?
Yeah, it's a great question. So, originally, Michael, so I started out, my family was in the hotel business. So I personally, grew up around the business. So my grandfather actually owned hotel properties. He also owned a business that my mom actually worked in the business as well. But he owned a business that did a lot of financing for hotel properties. So he did a lot of lending to other hotel owners. He owned hotel properties. So personally, I grew up around the business. When I graduated high school, so I lived in Alabama. Was originally going to be a doctor. That was my grandfather's passion for me, was to become a medical doctor one day. And when I graduated high school, actually ended up going to school at University of Texas at Austin and majored in biology because I was going to go down the path of being a medical doctor. During the 4 years I was at University of Texas at Austin, I just probably had more passion for business than going on and becoming a medical professional. So sort of pivoted. And when I graduated college, I had the opportunity to go work for a company that specialized in banking and capitalizing hotel projects. And so I actually went to go work for GMAC Commercial Mortgage within their group that specialized in hotel lending. So that's how I got into the hotel side of the business, and spent about 10 years in banking where I specialized in financing hotel projects and capitalizing different hotel projects, and financed over 300 hotel projects across the U.S. Before starting Peachtree Hotel Group. And I have two other partners that we actually started the company together, but we all have very similar backgrounds where we all personally grew up in the business, and then professionally we've all been in the business our whole lives before coming together to form Peachtree. And Peachtree is which I think a lot of people on this presentation probably are not familiar with Peachtree, but Peachtree is a private investment management platform that's focused on the lodging industry. So we have different investment vehicles that either invest on the equity side or the debt side of hotel properties, as well as we invest in some other commercial real estate asset classes. We also own several different companies that help to service the different investment vehicles that we sponsor. So we own a hotel property management company that operates over 70 hotels across the U.S. We own a development company that develops and renovates hotels. So currently we've got about 24 new construction hotel projects in our pipeline on the development side. And about half those, call it roughly about 12 of those projects are either under construction or getting ready to start construction. And the other dozen will probably start construction in the next 12 to 24 months. We own a lending platform that is called Stonehill, and Stonehill is very active in originating, underwriting, asset managing, servicing debt investments on primarily hotel assets, but we also finance even non-hotel assets through Stonehill. And currently we're servicing over 150 first mortgage loans on different types of commercial real estate assets, with again primarily hotel assets. We also own an asset management company and a couple other companies that help to optimize and derive the returns of the different fund vehicles or investment vehicles. So with that said, to your original question, how did I end up doing it? It was really just it was one of those things where just each step of the way I took advantage of just different opportunities that were presented at the time, and by no means when I originally started. And when I left college, I never intended, because again, this is 22, 23 years later, I never intended to be running, Peachtree or start a company like Peachtree. It just sort of, the opportunity sort of arose over time and sort of took advantage of those different opportunities and was able to sort of pivot to start Peachtree.
Thanks, Greg. Peachtree was founded right before the great financial crisis back in 2008. What were those days like, and what investment opportunities did you see in hospitality at the time?
Yeah, it's a great question. So, during that time period, during the Great Recession, there was a lot of opportunities both on the equity side and the debt side. We've always been, as an organization at our core, we're very opportunistic on how we approach investing capital because we are, investors first and foremost as an organization. So we're always focused on trying to, drive the highest returns. And during the Great Recession, there was just, an abundance of opportunities. So that it was, we were able to go out and buy a lot of distressed debt on hotels. We bought over, 45 or so loans, secured by different hotel assets. We were successful in buying a lot of hotel real estate during the Great Recession. We even went out and bought a lot of, different sites, really land, when I say sites, to develop, new hotels. We were able to sort of take advantage of the pricing, or really pricing had compressed down, and we were able to sort of take advantage of that and pick up, sites on the cheap, as well as, buying hotels on the cheap as well. So we were very successful in, investing capital both on the debt side and the equity side through the Great Recession, and because of, our success there, really led to, the growth of our, platform. But also when the pandemic hit, we were able to sort of, pull out that same playbook, and we were able to pivot extremely quickly and take advantage of, buying a lot of debt from different financial institutions.
Thanks, Greg. Investing in the commercial real estate space, especially within hospitality, is often referred to as a high-risk endeavor. Do you agree with that? And how do you mitigate that risk if so?
Yeah, so I mean, it is, there's no question, anytime you invest in any type of alternative investment, it's always going to be, higher risk than investing in something that's, that's liquid. So as you look at different, liquid type products, if it's investing in a CD or a money market account or a savings account, to investing in public securities, those tend to be a little bit less risky than an alternative investment where there's, lack of liquidity. But, us as an organization, we believe that we're able to sort of, beyond, generating returns that help to sort of compensate for that risk, we're able to sort of mitigate the risk by going in and, our platform, we have so much knowledge both on the, both on how to operate hotel properties, how to develop hotel properties. We know how to, obviously, finance hotel properties. So we know the hotel industry from all, from up and down the capital stack. We have a lot of market data internally because we do invest up and down the capital stack that allows us to have a huge competitive advantage when we're looking to make new investments. And we have a lot of data to point to on, what works and what doesn't work within the lodging business. But ultimately, we feel like we're able to mitigate risk on any investment because we're highly focused towards, certain brands that we feel like are proven and have, really good distribution. So that gives you a little bit more certainty of, of actual demand for your, hotel rooms. We're focused at, buying in at certain basis. We're big believers in, in hotels as well as any other commercial real estate asset class. You make your money on the buy side. So if you overpay on the, acquisition of a hotel property or on the, the development side, or even if you're financing a hotel, we're very basis centric. So we're always wanting to look at our basis and make sure we're at a level that is extremely sustainable. But, more importantly, we want to make sure we're at a, typically we don't want to be above replacement costs. We want to be at a discount, or, at or below, replacement costs, as well as, we'd like to be, at or below historical trades in those submarkets. So we're at a basis that's very, supportable and sustainable through various cycles. We're very focused on what's actually driving, especially on the lodging side, what's driving demand and how sustainable are those demand drivers for lodging in that specific location. And so we spend, when we're making investments, that's probably one of the biggest pieces on how we mitigate risk, is making sure there always can be a pandemic or some type of black swan event that's going to disrupt business flow. But we're big believers that if you really understand what's driving demand, eventually, in most cases, that demand's going to recover and come back. And historically, that's been proven within the hospitality business. So it's we're looking at what's actually driving demand and really underwriting. If it's certain types of businesses, or if it's leisure demand, whatever it is, we want to make sure it's sustainable and it's not business that's just happening artificially because there's been some type of event. If it's maybe it's a hurricane that comes through a certain area or some type of natural disaster that can spike up demand that's not sustainable. So we want to make sure it's real demand that's sustainable for the long haul. And then we're very focused on, because we're investing typically for the next 3 to 5 years. When we make an investment, we're not investing for the next 20 or 30 years, but we feel like we want to make sure we're protecting our exit. So we want to make sure when we buy assets, we're buying or even when we're financing assets as well, we want to make sure we have institutional quality assets. So we want to make sure the physical plants are been beyond being relatively well maintained before we buy them. We want to make sure we have assets that have really good structure and bones to them that can last for many years past our investment horizon.
Last year was a devastating one for everyone in the hospitality industry. What steps did you take for the survival of your hotel assets, and how are they doing today?
Yeah, so we, at the beginning of the pandemic, we were very, as an organization, we did a lot of different things to help, protect our assets, because we were invested at the beginning of the pandemic. Between our equity investments and our debt investments, we had probably about 130 or so investments, in hotel assets. Today, we have over 200 investments in different hotel assets because we've been very opportunistic and been buying a lot of assets. But at the very beginning of the pandemic, we were very quick to shore up liquidity, across our assets. So we were able to go in and, cut a lot of the labor expense. We were able to cut a lot of other expenses at the different properties. We were able to, do the same, corporately as well. We were able to, really, basically try to improve our liquidity position at each asset. We were very quick to restructure, different loans that we had on, certain assets and so forth to make sure we were freeing up as much liquidity so we had the ability to sort of ride through this, this disruption of business. Because we were at the very beginning back in, March and April of 2020, we believed that it was going to be a disruption for a period of time. We didn't, necessarily think it was going to last as long as it, originally did last, but we knew we needed liquidity and we needed to have enough, runway. So we were very successful in, shoring up that liquidity. And then we were, simultaneously, as we were playing defense across our portfolio, on the operations side, we made a very strategic decision to, although we were, trying to cut labor expense in certain areas, we really maintain our core, corporate property management team. When we kept, a very high focus towards, the sales. And when I say sales, having our sales team still in place to be able to go out and sell rooms, to put heads in beds and so forth, which paid dividends as the market started to recover. So fortunately, our hotels being mostly, select service, limited service, smaller full service hotels that are branded under the Marriott Hilton flags, although we were disrupted from the end of March till probably about June or July, we started having a recovery of occupancy back in July and August of 2020. And we were, very quickly back at a break-even point because we were so aggressive in cutting expenses and so forth. So we were, fortunately for us, we were able to sort of manage through it, and we were able to very quickly pivot and go play offense and actually, be very aggressive on buying existing hotels, as well as taking a very aggressive approach towards buying, debt positions from different financial institutions looking to sort of deleverage, their balance sheet towards lodging. So we believe we were very successful in, sort of navigating through the pandemic.
There was a lot of capital raised for stressed and distressed hotel assets during this time. However, the actual amount of distressed opportunities didn't materialize to the degree we all thought. Why was that?
Yeah, it's a great question. So there's there's a lot of different arguments and thoughts about it. I think probably the most realistic way to sort of look at it is the fact that in most cases most ownership groups had a lot of equity this cycle. Going back to 2018, 2019, most lenders continue to be very disciplined when they were lending to hotels compared to what we saw back in like 2005, 6, and 7, where most lenders were extremely aggressive before the Great Recession, which even caused more damage. Obviously, in 2009, 10, and 11, and 12, and so forth, where you had a lot more distress asset sales. So this time around, because the leverage points in the average leverage point in 2018, 2019 for most lodging assets were in that 50 to not much more than 65 to 70% loan to cost or loan to value, compared to during the Great Recession, most assets were levered at least 70%. In most cases, they were levered closer to 80% loan to cost, loan to value. In some cases, even higher. And so, because ownership groups had a lot more liquidity coming into this event, coupled with the fact that a lot of government assistance from PPP and some of the other government programs, coupled with the fact that a lot of lenders were willing to offer forbearance very early on and allow for deferment of payments, which allowed for additional shoring up liquidity for a lot of ownership groups. Most groups were able to sort of navigate without having to being a sort of a fire sale mentality. So you never really saw these huge COVID discounts on a scalable level. You saw some assets trade at a distress level on the real estate side, but you didn't see by no means did you see it at the level that we experienced back during the Great Recession. Where you did see distress though, and where we really did take advantage of on the distress side, we bought to date probably about $1 billion, $4 billion, $5 of hotel loans on different hotel assets across the U.S. And it was the debt trade where we had success going out and buying debt from regional banks, community banks, some of the national banks, mortgage REITs that were very concerned about what was happening with COVID and the disruption, and they really didn't want to deal with all the asset management headaches. So they were selling these loans at a discount, and we were able to successfully execute on buying different portfolios of loans from a lot of different financial institutions and banks across America.
Thanks, Greg. Peachtree did manage to acquire more than $1 billion in stress and distressed assets. Could you talk a little bit more about what type of assets those were?
Yeah, so mostly, most of the assets, were, select service, limited service, some full service hotels. Most of these assets were ones that were in a market, because across the hotel industry, interestingly enough, I think probably most of y'all realize and appreciate that most hotels in these leisure markets, like we have hotels down in the down on the beach in Florida, for instance. Those hotels, even through the pandemic, did extremely well. And today, most of those hotels are actually performing better than what they were doing pre-pandemic. And so, and by a considerable margin now, they're doing much better than they were doing pre-pandemic. But the hotels that were in these sort of corporate type markets, or markets that had a lot of focus towards convention type business or group type business, those hotels were severely impacted for most of the pandemic, and some of them continue to be challenged, get back to the same levels that they were experiencing pre-pandemic. And so ultimately, those were the types of hotels, and I would say for a big part of what we bought were hotels that were sort of these select service, limited service hotels, feeding and relying on corporate demand, relying on group and meeting demand. In some cases, they had some leisure components, but it wasn't big enough to compensate for the for the loss on the corporate side or the group side. And so it caused, because these hotels were tripping up covenants, loan covenants, it caused a lot of these banks to want to look at selling the loans off, because they just don't want to deal with TDRs, which is troubled debt restructures down the road. And so for them, although they have coverage where they don't have to qualify or classify hotel loans as TDRs today because of the CARES Act, a lot of them are concerned because that coverage to basically give them coverage so that they don't have to, classify hotel loans as TDRs burns off at the end of this year. And so a lot of banks have been very aggressive in just selling off paper, not only this year, but, even last year in 2020, they were super aggressive because originally that coverage ended at the end of, 2020, but they ended up extending it through the CARES Act, at the end of 2020. So.
There was a recent article in the Wall Street Journal on the growth of non-bank lenders. Peachtree has a lending arm, as you mentioned in the beginning of our talk tonight, Stonehill. Has this division seen strong growth, and who primarily are those sponsors?
Yeah, so I mean, it's there's a lot of groups, like I would say like us, private equity shops that are, that have started these non-bank, lending units that are, in a lot of cases, they're, trying to aggregate, loans to potentially securitize off through some type of CLO. In other cases, they're like us, where, we're holding these loans within our, the different investment vehicles that we sponsor. So we consider it a little bit more on balance sheet. In some cases, we'll partner, with different banks or other financial institutions where we'll hold back a B position, so we'll hold back a first loss position in a first mortgage loan, and we'll sell off that the A portion or the super senior portion of that first mortgage loan to different, banks and financial institutions. So we do partner with a lot of, different banks, but most of the groups that we are competing, with that are non-bank lenders are a lot of, private equity shops that have, seen, sort of what we've experienced, because we've had, Stonehill going back over the last, 8 years, 9 years, actually. So we've been actively direct lending, part of our company for the last, 9 years. And so it's been one of those things that I think a lot of groups, especially over the last, 15 months, because there's been so much money raised to go out and do the distress trade. And given that there hasn't been a lot of distress on the equity side, a lot of those private equity funds have sort of migrated into trying to do, more lending and lending towards hotels, because most hotels, although they may not be trading at distressed pricing, they are, they are still in some level of distress from a performance perspective.
Let's shift away from the lending aspect now and talk a little bit about some trends in the industry. Are there any underlying trends in the hospitality sector that you're concerned about, such as Airbnb as an alternative to hotels, or Zoom as an alternative for business travel, as some examples?
Yeah, so I mean, there's been a lot of debate on Zoom, how that's going to impact, the future of lodging, because, as we're all sitting here today, we're doing this, Zoom meeting. And, there's the debate, is it easier for us to, all meet through Zoom, or would it be more effective if we were all in the same room together? And I think, personally, we believe, and I really believe too, that Zoom is going to have, some level of impact on the way business is conducted. I don't think it's going to impact necessarily or have a meaningful impact on room demand from a negative perspective. I actually think it's going to induce demand, because I do think Zoom is going to allow for everyone that's, on this or in this meeting right now, for instance, as you get, as you're, working, now you can work pretty much anywhere in the world and work for different companies. And, if you work for any organization, there is still the need to get together in person. So you may, work, 1 month away from the office, and you can work from wherever you want to, but then eventually you're going to have to go back, to the home office. And as you go back to the home office, ultimately, you're probably not going to, carry, a house wherever you live and then have a house wherever your office is. Most likely you're going to be staying in hotel rooms. And so that's one way we believe Zoom is going to end up inducing more demand for lodging, is that, that ability to allow people to work, anywhere and then travel back to the home office, which we think is still, there still needs to be that level of connectivity in person, and you can't, build and train and develop teams, through a Zoom call. You actually need there's a certain amount of, having in person and, building those relationships and training, and especially developing younger employees. There needs to be some form of interaction in the office as well. So, we're big believers that Zoom will most likely not, impact, lodging demand on a negative note. It's most likely going to have a positive impact, just from inducing more demand. I think Zoom could, ultimately impact maybe the groups that go out and do a day trip, because the need to do a day trip for one meeting that's going to last 1 hour becomes in question. But if you're going and traveling and actually meeting someone for lunch or dinner, you can't do that over a Zoom call. And you develop through lunches and dinners and meeting someone just for drinks, or meeting someone for breakfast. You develop a different type of relationship, and your relationship becomes a lot deeper. And so you're still going to have to travel, and most likely when you do those types of meetings, you're going to be staying overnight, and that's going to continue to need for demand for lodging. In regards to like Airbnb and just sort of shifting, there's been a lot of discussion pre-pandemic. I mean, that's part of the reason hotels never experienced the compression in cap rates that we saw with a lot of other commercial real estate asset classes, pre-pandemic, because hotels have always sort of traded in the, 7 to 9% cap rate range. And, we saw a lot of asset classes like self-storage and multifamily, compressed down, considerably from their, historical averages. Hotels really never compressed down, and you could argue they actually sort of went up in a lot of, different submarkets, but and part of it was the fact that a lot of groups were fearful how basically Airbnb was going to impact our business. But it's sort of similar to a lot of people were afraid it was going to be similar to what we saw with Uber and the taxi industry. I think where most people have sort of gotten it wrong is the fact that Uber made the taxi industry was a very inefficient business. It was a very inconsistent from an experience perspective, whereas Airbnb, really didn't, because of the brands, the hotel business was already very efficient, very consistent from an experience perspective, because the brands sort of require it. Because if you're staying at a Marriott Courtyard in New York, they want that Marriott Courtyard experience to be the same in Birmingham, Alabama. So no matter where you stay at, where it's a Marriott Courtyard, there's certain features that are going to exist. And so you already had that consistency piece, and then you already had the efficiency piece from a standpoint of booking reservations, because you could do it through your phone. Whereas ordering a taxi was very inefficient because you had each city, each state had different phone numbers, different taxi services. Whereas Uber made it more effective and efficient because you could just do it through through a couple of clicks on your phone. So with all that being said, I guess where I'm trying to get at is, ultimately Airbnb, if you look at all the data pre-pandemic, it wasn't taking away business from our hotels. It was only impacting our ability to drive rates on nights that were, high volume nights. Like if the Super Bowl was in Atlanta, there was a natural ceiling that was occurring on the type of rates we could charge because there was this phantom supply where somebody's willing to rent out their house. If all of a sudden they can, rent their house for $10,000 a night, well, they're going to, rent it out for the Super Bowl. But that supply doesn't exist permanently. It's a short-term supply. And then the guests that stay at our hotels traditionally prefer to stay at a, branded hotel. That's why they stay at our hotels. And so, ultimately it wasn't taking occupancy away. It was just impacting our ability to drive rates. So it was creating sort of a rate ceiling. So that's the only impact we've seen from, Airbnb. So, Airbnb and, Zoom, although they're both, I think they're very effective tools for, certain types of travel. I don't think it's going to impact, our direct business of being invested in these, select service, limited service type hotels and, smaller full service hotels, where Airbnb is really, where you're really seeing Airbnb, for instance, disrupt a business. It's really the local real estate company that was renting out homes, like down in the beach. And I'll use, Florida, for instance. I used to, own a house or own a condo that was on the beach down in Orange Beach, Alabama, which is right next to Gulf Shores and Pensacola Beach, and had a condo there. And I used to, I hired a third party management company to run it for me. That was a local real estate company, and they were able to. And part of the reason I had to hire this company is because they were renting it out when I was not using it. And the need for that company today has probably been, it's probably been lessened just given the fact that, now I could, if I own that condo today, I could easily just put it on Airbnb and hired some type of maintenance service to, oversee that property and save, a decent amount of money. So that's, that's my opinion on those. So I think ultimately the biggest risk, we have in the lodging business is, anything that's going to disrupt the permanent need for travel. And, I really don't see anything in the short-term horizon that's really, outside of, the pandemic, health related reasons why people won't travel. Now, outside of that factor, I really don't see anything in the short term that's going to impact lodging. I think long term, you could see an impact at some level towards lodging as private planes and as cars are able to drive, drive without, automatically, without, any physical driver. Those are things that could all of a sudden make it easier for someone that's traveling on the road to not stay at a roadside property because they could easily, sleep while their car is just automatically driving them back to their house or whatever the case is. So, things like that are probably risks down the road. I just don't think it's, it's not quite there yet. So,
thanks, Greg. If you can look in your crystal ball, where do you see opportunities, and what's your forecast for the rest of this year and the years to follow?
Yeah, so I think the biggest opportunities, I think really within lodging and really speaking in that regard, I think there's a huge opportunity in front of us just that's going to sort of crystallize over the next, 60 to 120 days. I think you're going to see a lot more opportunities on the acquisition side, buying hotels, which that really hasn't existed over the last, 15 months, but I think it's starting to materialize as we speak right now because there's a lot of pressure points coming. You've got the brands, like the Marriott and Hilton brands that are now starting to require hotel owners who have not renovated their hotels, because a lot of renovations that were supposed to take place over the last 15 or 18 months have been delayed because of COVID. So a lot of these hotels now need to be renovated. Unfortunately, a lot of hotel ownership groups have utilized their FF&E reserves, so their renovation reserves they've utilized to make it through the pandemic. And now they're going to need to, find capital, to do these renovations. And so I think that's going to motivate a lot of hotel owners to look at selling hotels, given the brand pressure to complete renovations. I think the lender pressure is going to continue to exist as loans continue to mature. Loans continue to be in, some level of covenant default. I think that's going to help, further facilitate asset sales, coupled with a lot of groups are just hitting fatigue. They've been invested because most hotel ownership groups are investing for a specific time horizon. And, that we've had, really close to, when this is all said and done, when you look out 60 to 120 days from now, you're hitting on almost 2 years of, really not a lot of meaningful asset sales. And so, I think there's going to be a flood of hotels for sale, and that's going to help sort of, bring pricing down to more of a opportunistic level where I think it's going to make a lot of sense to be out there buying hotels, especially given the fact that on the other side of the equation, when we wake up, over the next 12 to 18 months, we're very bullish on the hospitality space because we believe the current environment is setting up for us to have an incredible couple of years within lodging from a top line performance perspective, as well as even from cash flow perspective, because we believe just the inflationary environment, hotels reprice daily. So we're able to move our average daily rates up, as inflation's in the environment and as demand is surging. And we're seeing that in the leisure markets. Our hotels down on the beach, it's most of our hotels over the last, 3 to 6 months are probably up over 20% in average daily rate compared to where they were in 2019. And, the average daily rates is what, being able to charge, $200 a night versus back in 2019 for the same time period, we were only charging, say $150. That extra $50, 85% of that's going to probably flow to the bottom line. So it's very, that's very profitable for us as an, as an industry. And you're seeing in these leisure markets, demand is pretty much the same, if not greater than what it was in 2019, coupled with those higher rates. We think the same is going to exist as corporations start to reopen, as well as, group and convention business starts to, recover. we believe you're going to see this huge surge in rates that's going to, allow our business to be super profitable. And so we're very bullish on, buying existing hotels. And we're also extremely bullish on developing new hotels. That's where, probably the other opportunity in our space is today, because there's been such a lack of new hotels being built because, it's hard to get financing. Construction costs have risen so much just given a lot of the inflationary, pressures and supply chain disruptions that have occurred. But because of those challenges, it's caused a lot of groups to really table any development projects. We're sort of taking the opposite approach. We're using this COVID disruption as a period of time to actually sort of ramp up even more development, because we believe, the one thing that always is more profitable in our space is if you can develop new hotels, because the guests prefer new over, older hotels. We believe that as these new hotels open, we're going to be able to, sell them for a really nice, really nice reversion compared to what we're building these for. Just given the fact that, there's such a lack of new product, and all the, public REITs, institutional investors are seeking out newer hotels. And we're actually seeing that. We have a lot of hotels that have opened during the pandemic, and we're actually selling a lot of those hotels at really good pricing today. So we're pretty excited about the development side as well.
Thanks for letting us see into your crystal ball, Greg. But now let's shift focus and look backwards for a little bit. What have been some of your proudest moments at Peachtree?
Yeah, there's been a lot of great moments. Probably the proudest is actually just getting through this pandemic, because we were able to, coming into the pandemic, we had about a little over 100 corporate employees. We had about 104 corporate employees at the start of the pandemic. We ended up, fortunately, we were able to keep 98% of our team. So we had unfortunately, furlough 2 of our corporate employees, but we were able to keep 98% of our team intact. And then not only were we able to keep the team intact, we've been able to grow our corporate team from being at 104 back in 2019 to today, where we have closer to 135 team members, and we're growing. So I think, us being able to continue to be opportunistic, take advantage of the pandemic, being able to quickly shift and play defense, and then turn around and play offense, so that we could continue not only to exist as an organization, but really thrive on the other side of this, this black swan event. That's probably one of my proudest moments, and just watching, our team, develop out, because we have, team members that are, fresh out of, that were joined us fresh out of college. We have team members that have a lot of experience and knowledge in our hotel space. But I love seeing how our team has come together as one, and been able to sort of, fight through this pandemic, and watching, especially a lot of the younger team members, mature and grow through this, through this type of, event. So it's been really, for me, that's probably one of the proudest moments for me today.
Speaking about team, what makes someone successful at Peachtree, and more broadly in the real estate industry overall?
Yeah, I think there's probably a lot of good answers. I'm a big believer, if you're focused, and it's not even just real estate. I think it's whatever you're doing from a professional perspective, and you probably can even apply it to your personal life. I think a lot of times, people get so caught up in the outcome. I'm a big believer, focus on the input, focus on what you're putting into a relationship, focus on what you're actually doing, and make sure whatever you're doing, you understand it, you're doing it the right way, and not so focused on, the outcome, and what's, because, everyone wants to end up, if it's in the real estate business, everybody wants to, develop more hotels, buy more hotels, but you can't, manufacture, good deals. You've got to go out there and, work hard. You have to develop relationships, and it all comes back to what you're willing to put in to those relationships, what you're actually, willing to, sit down and learn and study on, understanding different submarkets, understanding different types of assets. So it's, spending that time and not so focused on worrying about if it's, leading to immediately to a win. Being, if you're in the real estate business, you finding something to buy or something to sell. So you have to actually, I think within our organization, We're big believers in, giving a lot of, allowing our team be, very independent, but be extremely entrepreneurial. And we want them to be, creative and innovative when they approach their job. So I think, for someone to be successful within our organization, I mean, they really have to buy into the fact that, they're willing to, really focus on, being entrepreneurial and being willing to make, decisions. And sometimes we're all human. We're going to make, everyone's going to make bad decisions at, any given time, but, willing to, go back and, figure out, when you do make a mistake, learn from it and, move on and don't dwell over it. So.
And finally, what was the best piece of advice you've ever received? I'm sure you received lots of great advice throughout your long and impressive career. And what advice would you give your younger self if you could go back?
Yeah, so probably the best advice, and I sort of said it a minute ago, but probably the best advice I'd give myself is, as I just think about like my career as it transitioned, because, when I was younger in my career, I was so focused, again, on the outcome. If it was finding a way to, my first job, it was so focused on, getting promoted or, having immediate success and really, slowing down and, beyond just enjoying the moment, actually, really focusing on what I was, doing with, different relationships and developing out, especially, in a younger setting, developing out relationships, because those relationships, the people you're meeting, the people you're dealing with, they're all going to grow, within, especially if you stay within the same industry, they're going to grow and they're going to, move into, other positions and those relationships are going to become invaluable. And I think that's, really making sure you spend a lot of time in developing, trying to maintain, long-term relationships is probably one of the biggest, things if I had to look back on my career today, that's probably one area that, I think I did an okay job with. But if I could go back in time, I think I would probably spend more time on, not only developing relationships, but really focusing more on what I was doing, from a standpoint of just the work product versus worrying about trying to get to, out to the outcome of, what work product was going to produce.
Thanks, Greg. Now I know we have a lot of eager audience members. Maybe we could take a few live Q&A questions before we wrap up tonight. Who wants to kick us off with something? Raise your virtual hand and I'll be glad to call on you. First come, first serve. Oh, Cole has a question, but his hand's broken again. His virtual hand, his good hand, his real hand works well. Go for it, Cole.
Thank you so much for talking. I really learned a lot about the hotel space, and I found a lot of what you're saying about all the opportunities generated by COVID to be really interesting. I was just wondering, coming out of COVID, what submarkets are you finding most promising? Are there ones that are more suited to development, and are there ones that are more suited to acquisitions?
Yeah, no, it's a great question. So I think, it's a debate that we have internally every day. So I think the markets that are probably from a standpoint of, as we look at the industry today, any market that has a huge focus towards leisure demand are probably the most viable markets today, because those markets are recovering. You have cash flows in those types of markets. And then when you look at forward bookings, they're extremely strong in these leisure dominant markets, especially ones that are, hotels that are, on the beach or near a beach, hotels near, any type of recreational type activities. Those are probably the most promising from a short-term, performance perspective. But if you're taking more of a approach, because a lot of those hotels, if you're looking to invest, you're paying, in a lot of cases, you're paying a premium compared to what you would have paid in 2019 to buy those hotels. So if you're taking more of an opportunistic approach and want to buy stuff, that's at a, potentially at a distressed type pricing, the better place to sort of, seek out opportunities are in these more, business centric type hotels, where they're relying on the corporate demand and the group demand. And as well as, looking at hotels that are, larger full service hotels, because these full service hotels are relying on, they definitely need, because a lot of them have a lot of meeting space and they definitely need people to congregate and come together, which, unfortunately, a lot of meetings and conventions have been canceled because of COVID. So those hotels are still, in a lot of cases, although their business is much better than what it was at this time, last year, it's still, down materially from where it was pre-pandemic. So you can find better value in those assets, but you still have to ride that wave of, uncertainty on how those markets are going to recover. But we are, we're buying hotels as we speak. For instance, we're buying 2 hotels down in, Miami right now, and we're buying several hotels that are in these, downtown type, CBD type locations. So we're not afraid to, buy in both types of markets, and you can still find value in both places.
Hi, Greg. Great to meet you, and thank you so much for finding the time to speak to us. This was really, really interesting. I'm also very passionate about the hotel industry, and I actually had a question for you about if you could speak to the advantages of partnering, with these big brands like Marriott, Hilton, Hyatt, and the sort of advantage that brings to you, and even just the marketability of selling these assets once you decide that your investment horizon is over. And the second question I had is, you've had great success in the US. What are your thoughts on sort of other markets, and if you're looking at any sort of international markets now that you're coming through COVID? Thank you so much.
Yeah, no, it's a great question. So the brands are, extremely, for our industry, they're extremely powerful from a, distribution of business, because they have that distribution channel that, really the reservation system that drives occupancy, into our hotel properties. So, the brands are very powerful from that perspective, as well as when we go to sell hotels, there's more, there's more capital chasing, like the brands that are well known, like a Marriott or Hilton, or even Hyatt and Intercontinental hotels. Most of the institutional investors, the public REITs, they're all seeking those types of assets, which allows for you to sell, your asset at a lower cap rate or a higher multiple in cash flows. So it's a very beneficial trade to stick with those brands because of it. Because ultimately, as we partner with, Marriott or Hilton, we're really just, entering into a franchise agreement with those brands. So ultimately, we have a license to operate their names, in these specific submarkets or locations, across America. In regards to going international, it's something that, we've talked about internally. I mean, there's just so much, political risk as you go from one, country to another. We talked about partnering with different groups in the past that have that, expertise from a political perspective in these different geographies, but we just haven't, for us, we haven't, moved in that direction yet. And, in the short term, I don't expect we are going to move in that direction as an organization. What we are doing as an organization, we are starting to pivot into some other asset classes, because we, we really started a company from scratch, but brought over a couple of people from a, from a similar company to start it. And it was a commercial PACE lending program. So it's a commercial lending company we started that's been very successful, over the last 18 months. We've done close to 300 million in loans in that company, or, to borrowers. And we've been financing multifamily, senior living, student housing, and so forth. So it's an area that, we're starting to grow into some other asset classes on the lending side. And that's, I see us growing in different asset classes within the US a lot quicker before we expand internationally, just given the political challenges.
Hi. Well, first of all, thank you, Greg, for all this great information and for taking the time. And well, I wanted to ask you, maybe this is more of a personal opinion, but I really like, whenever I travel, to do like my research and ask and see like about the hotels in the city I'm going to. So in your opinion, like, what's your personal favorite hotel chain or brand? What's your like go-to?
Yeah, so you're probably asking the wrong person, because whatever hotel we're developing at the moment or getting ready to open up, that's my favorite hotel. But in all seriousness, it's personally, when I travel, I love, I love staying at Marriott and Hilton branded hotels to begin with, but I like a lot of these lifestyle. There's like a lot of new lifestyle brands, or these soft brands that are part of Marriott and Hilton. You have like the Autograph Collection, you have the Curio Collection. And I like a lot of these hotels just because a lot of times they carry the character, and there's an experience factor that's more localized for that area. So within, the U.S., I love a lot of times staying at like a, Marriott Autograph Collection that may be in a certain submarket, or Curio, which is part of Hilton. I also like, Marriott ACs. I'm not sure if you're familiar with that brand, but, Marriott had bought that brand going back about, I guess about 10 years ago now. They bought it, it's a brand that's over in Spain. So, the AC brand was popular over there. Marriott's brought it to the US. We've developed, I think we've developed probably 3 or 4 of them from the ground up. We own several, and we've had a lot of success, and we've made a lot of money, with that brand. So I'm a big believer in that brand, just given how it's performed, and from a guest perspective, I love staying at that type of hotel as well. It's a great public facility, or the public area is really good, as well as the rooms are, to me, are very efficient, and it's a good experience.
So on Tuesday, actually, at our real estate meeting, we were going through CBRE reports, and I had the hotel industry with a little team. And one of the challenges they brought up was the labor pressures happening in the hotel industry. There's the current labor shortage, and also labor costs are rising. So how do you see that impacting the hotel industry going forward?
Yeah, so it was hard to hear the question. Was it how the labor markets are impacting hotels?
Yes, correct.
Yeah. So labor markets, I mean, our business, like like any service-based business for sure, and even some non-service-based businesses are being hugely impacted by the labor challenges. It's hard, our hotels, for instance, right now we have probably, I think, call it 1,400 team members at the different hotels that we operate today. And we probably should have closer to 2,500 team members. So it's hard to get our hotels, although we need to get our hotels fully staffed, it's hard to get enough people to come and work, across the US. So labor is a huge challenge of getting people. And then the other part is just the cost of that labor has risen so much because, everyone's, because of inflation, I argue that, inflation, although there's all these arguments about it being transitory or not, but as you look at how fast, payroll is going up, it's hard to believe that this is going to be transitory, but who knows? But with that said, I think it's there's no question that has been a material increase on the labor side, on the cost, just because you have to pay more to get good team members to actually work at the hotels, and labor is a big component to to our business on the lodging side, because we're servicing these guests that are staying at our hotels. So it has definitely had to a certain degree, it's, the labor's costing more, but our hotels are understaffed. So ultimately the profitability at our hotels, because they're understaffed, you could argue that we're more profitable today than we were pre-pandemic, although labor cost is probably up at least 20-30%, especially for the hourly employees at each of our assets.
Greg, it's been an absolute pleasure. Truly, your time and courtesy means a lot to this group. So thanks again. Really, I just thank you, Greg.
Yeah, no, thank you. And I wish y'all, much success. And if there's ever anything I can do, feel free to, share my email address and contact information. Happy to help you out or answer any questions I can. So feel free to reach out at any time.
Thanks, Greg.
All right. Sounds good. Talk to you soon.